Earlier, I spoke with Professor Steve King, author of Debunking Economics, and I started out by asking him what he describes as the different economic religions.
I'll start with the dominant one, which is called neoclassical. And that school of thought includes people who, in the media, would be called Keynesian at one extreme, Paul Krugman, and at the other extreme, they'd be called what is termed freshwater economists, as opposed to saltwater like Krugman. They're also neoclassical. They start from the same basic idea of how the economy operates and how people behave in the economy, and they simply have different nuances at one extreme or the other. When they call themselves Keynesian, these are people who've been taught Keynes as he was interpreted by Paul Samuelson. And there was such a reaction by acolytes of Keynes to Samuelson's, what they saw as complete distortions of Keynes, that another group broke away completely and called themselves post-Keynesian. And they based themselves much more on the original works that Keynes did and the emphasis he had upon uncertainty. So there's neoclassical, which is by far the largest group, post-Keynesian, which is a protest group that goes back to Keynes talking about uncertainty and being out of equilibrium. And then there's an Austrian school of thought, which comes out of people like Hayek and von Mises and so on.
Rothbard.
Pardon?
And
Rothbard, yeah. And they're actually closer in terms of their theory of value to the neoclassicals, but they're closer in terms of how they talk about instability in capitalism and disequilibrium and the behaviour of finance to the post-Keynesian. So there's quite a mess there, and very, very hard to get reconciliation across that. And
the Austrians, they talk a lot about the ordinal value of various things, ordinal value of preferences and the marginal person. How does that fit into the Keynesian world or the post-Keynesian world?
Well, the neoclassical world is quite consistent because the neoclassicals and the Austrians both believe that people are out there as utility maximizers and the firms are out there as profit maximizers, and we have to work from the individual level up to understand the economy, and that's how they think about it. The post-Keynesians don't really have a coherent theory of value like that, but fundamentally they start saying there's objective factors in the economy, costs of production determine prices, profit, the whole idea that you can maximise is seen as being a naive view which doesn't take account of uncertainty about the future. And you can't maximise what you don't know. And therefore you have to behave in the face of uncertainty, and therefore you'll take rules of thumbs and you'll extrapolate current conditions and so on, and you'll go with the herd. So there's much more an idea of being able to fine-tune how you slot into society in the neoclassical and the Austrian view, whereas the post-Keynes is much more likely to say it's an uncertain world out there, and people will go in group behaviour, much more socially class oriented in how they think people behave, and people behave in the face of fundamental uncertainty about the future. So they will extrapolate. They won't be behaving. They'll behave sensibly given what they know, but what matters most is what they don't know.
Let's talk about the role of banks. It seems that they are excluded in a lot of these models, and this is something that you talk a lot about.
Yeah, what is the role of banks? The point which you would think the crazy people would be the ones who say you can analyse capitalism without including banks, debt and money. Well, you're right, and they're the neoclassical. They dominate the profession. So the standard theory, the Bernankes to the Krugmans to the Cochranes and so on, and way back in Samuelson as well, said you can model capitalism as if there are no banks, no debt and no money, and we all do barter. And we're saying that ain't capitalism. You know, whatever you're analysing, interesting little fictional world, but it's not the real world. So you must include banks, debt and money in the way you model the economy. And when you do that, of course, that what banks do has a dramatic effect upon how the economy operates. And that's what I fundamentally analyse.
Well, we actually have a chart here of yours, and it is of U.S. private debt to GDP ratio in the past 5 years. And private debt reached record highs starting with this graph in 1920s. So are you still expecting to see a private debt deleveraging? And what would trigger this?
Yeah, actually, I'm just working with Richard Vague and the Governor Woods Foundation right now to revise those figures, because we found I'm actually including some bank debt that I shouldn't include in the private debt there. So we're going to be changing that chart at some point. But yes, we have got to a level of debt in terms of the private sector debt, which is probably 3 times the level which I think is sustainable in the long run. So we're going to see deleveraging, which is roughly equivalent to 1 year's GDP driven out of the economy. But there can be periods where people go back into borrowing money again. And one reason we're actually seeing a bit of a boost to the economy right now is people are re-leveraging, particularly businesses are borrowing money again. So,
does this have anything to do with Fed policy?
Yeah, I think the Fed policies encourage people back into debt again. I mean, fundamentally, they don't realise this, but a major reason why the economy has recovered to some very, very minor degree is that by all the stimulus that the Fed's pumped in, it's slowed down the rate of private sector deleveraging and then encouraged people back into debt to buy shares and buy property and so on. And that's actually giving a debt finance boost to the economy that is making things better than they would be without the debt finance boost. But of course, we're getting back into the same unsustainable territory again.
Yes, and what do you think the trigger event will be, if any, that causes this actual deleveraging? Is it a crisis of confidence in the U.S. dollar? Is it in Europe? Is it China? It could be basically... It can be
a whole lot of external things, but it can also be the internal one that because when you're borrowing money and you're spending additional borrowed money, you're stimulating the economy, but at some point people start to worry about the difference between their income and the level of debt they've got. And so if you get a reluctance for people to take on more debt, then that can cause a downturn. And that itself can happen simply out of things like as it did during the property bubble. People were borrowing money to buy houses, and lots of people were losing money on that trade. They only managed to get out of it because they could refinance.
It was a game of musical chairs almost.
Yeah, so once you get a faltering in that rate of growth of prices, that can trigger people to start losing money, and then the borrowing, the acceleration of borrowing, which is necessary to keep that going on, slows down. And so a simple slowdown in the rate of growth of the change in debt can be enough to trigger a downturn. And that's what happened back in began in 2006 with the housing market. It took till 2008 before the rate of change of debt went from rising to falling, and then when that happened, that's when the downturn occurred.
Right, and especially we saw with the Fed in 2004, 2005, keeping interest rates really low, almost record low at the time, 1% for over a year, and now we're almost 5 years into a zero interest rate policy. What effect, where can we go from here? Is the Fed stuck in a perpetual cycle? Well,
because the Fed won't do, which I think they should have done, they should have actually got in there and rescued the debtors, not rescued the creditors. They tried to keep the banks alive that would lent the lousy debt, rather than getting the debtors out of a debt they should never have been enticed to in the first place. So long as they remain just thinking they can do it by increasing the reserves of the banks and by not directing money to Main Street rather than Wall Street, we're going to continue falling back into this crisis. And the only way that their policy has worked is by inflating asset prices. And that was a deliberate policy.
Yes, and they have that. I mean, we see rising stock market prices. We actually have a graph here. It's the ratio of margin debt on the New York Stock Exchange to GDP, as well as the Dow Jones Industrial Average. And you might recognize this graph.
I almost fell over when I plotted that for the first time because,
you could even go back to the 1920s, and it was a similar story. This only goes back, I think this goes back to 1940s or 50s, but it's the same story.
Exactly. The margin debt drives the level of stock prices, and it's a positive feedback loop. If you see the stock market rising, you're more willing to take out margin debt to gamble in it, and because you take up the margin debt, you leverage up the asset prices. But the positive feedback loops are just like going to a concert where somebody puts the mic too close to the speaker. What happens is it goes wham, and then it breaks. And that's what we see happening. The rises and the falls there are the positive feedback between the level of leverage and the level of asset prices.
It's all about the liquidity.
It's all about leverage. And unfortunately, we've let the banks get away with dramatically excessive levels of leverage, which works for a while and then causes a collapse. And that's no right way to run a capitalist society.
What is the right way to run a capitalist society?
You've got to constrain the banks.
And how do we do that from a regulatory perspective?
I don't think regulators can do it. I think regulators are too slow-moving, too likely to get seduced by the banks over time, as certainly happened with the regulators since the Great Depression. What I'd prefer to do is to set up rules that are court-driven about the maximum amount of leverage that a bank can offer for a particular type of purchase. So I have one thing I call a PIL, which stands for Property Income Limited Leverage.
Okay.
Pardon me.
Sure.
And that is to say that rather than banks lending supposedly on the income of the buyers for a property, the maximum they can lend is also controlled by some ratio between the income of the property itself and the amount of money they can lend. It's like if you and I, right now, if you and I are competing over some property in Washington somewhere, and the property earns $50,000 a year in rent, that's irrelevant to us, and you and I will fight over it by trying to get higher leverage. We have the same income, and the one of us would win with the one who got the high level of leverage from a bank, which makes us want high leverage. What I want to do is change it to say the banks can only lend up to a maximum of, say, 10 times the rental income of the property. So that property earned $50,000 a year. The most either of us could borrow is $500,000. And then if you want to get it more than I do, what you've got to do is save more money. Okay?
Savings.
That's what I want to do. I want to stop the positive feedback between leverage and asset prices. And you can do a similar thing on share markets as well.
Steve Keen, this has been fascinating. Thank you so much for joining me.
You're welcome.